Okay, good evening. Welcome back to Hurdle Rate. Today we're going to do a DCF, build a DCF model for Target. It's not going to be like the ones we've done previously, which were free cash flow to the firm. We're now going to do a free cash flow to equity. And this is going to basically tell us how protected Target's dividend is based on its ability to generate free cash flow to equity. So after the debt has been paid, so what cash flows are there to pay the dividend, and it's basically, well, the reason I've chosen Target is because it is a dividend king, meaning it's paid a dividend and increased the dividend every year for at least the last 50 years. I think Target's is a bit longer than that. There's something like 56, 57 years of consecutive dividend payments, and not only that, the dividend is growing. But if we look at the chart for Target at the moment, it's over the last decade, it's not looking very pretty. It had this huge peak with huge surge in 2020 and 2021, but now the price has come back down to where it was 5, 6 years ago, which doesn't look great, especially when you see its rivals such as Walmart and Costco, and so like Home Depot we looked at the other day, all near their all-time highs. So yeah, let's get cracking. Let's start building the DCF. It's going to be done a bit differently than we've done previously, because obviously we don't need to build a weighted average cost of capital. We just use the cost of equity, because we're not factoring the debt holders in this analysis. Okay, so we've get a blank spreadsheet. First thing we do, we go view, not view, sorry, page layout. Take off grid lines. Then we go view and we freeze the first column. We insert another column and we make the A column a bit smaller and we make the B one a lot bigger. We're going to put here, what's this? TGT is the ticker. I'm going to zoom in a bit as well. So yeah, that's a bit better. We select the data tab and we go stocks. Come on, there we go. Ticker date. We want the current. Yeah, we want the current, implied, then an up, down. Come on, why is this taking so long? Select. There we go. Equals A1 dot. What do we want? Ticker. The date today is the 23rd of September 2025. The current price equals A1 dot. Open the parentheses. Maybe. Okay, looks good. Let's do a bit of formatting. Sorry, I forgot to put the color in. Then obviously the first line is always you put your little X there. Is the assumptions. We need a blue font, put it to white. Assumptions, revenue. Target breaks down its revenue segments into quite a few, as you can see here. It's 1, 2, 3, 4, 5, 6, 7, 8, 9 sections. No, sorry, 10 if you include other. Credit card, advertising. Then yeah, okay, yeah, so there's quite a few for us to go. Then we'll be able to see which part of the business is performing and which is not. How many do we need? So 1, 2, 3, 6, 7, 8, 9, 10. 4, 5, 6, 7, 8, 9, 10. Beauty, food and beverage. We have advertising revenue. Advertising, we do need to put credit card, profit sharing, and other. Oh, I missed out one. Other merchandise. Let's call that other merch. And just put all of these down to 2. I didn't do that yet. So we want to copy them over onto this side. Let's make these bold as well. I'm going to zoom out slightly. Yeah, they can still be seen. Then we need net income. Instead of the EBIT and the operating income, we're going to use net income. Net income, cost of equity, terminal growth value, then cost of equity, TGB. Okay, looking good. Now onto the revenue build. We'll start with 2022. Go out to 2030. It's a fairly much. Oh, sorry, you didn't see. My mistake. I'm going to zoom out a bit. Revenue segments, apparel and accessories. So we're starting with B9. Okay. Equals B9. Percentage growth. We want bare base bull and percentage of revenue. We don't always use a percentage of revenue here at the bottom, but it could be quite good to sometimes, if you want another way to forecast what future revenue will be. It's going to be loads of these. That's still visible. B14 so equals B15. Sorry. B17, then last one. Oh. Okay. It shouldn't take us too long to do all of these, but let's just blast through them. Okay. So. Number 1,000 separator, perfect. We don't want that. Okay, let's go. 17,646. Can you see? Let me come back in a bit. Seventeen six four six 16,485. 16,505. The percentage growth, you take the most recent year divided by the previous year, -1, and then you just put it into a percentage. And you can just copy that over. So, I mean, apparel and accessories are going down by quite a bit. Let's see if that pattern is the same for all of them. It looks like it so far. 13,173. 12,538. No, sorry, I got that wrong. 11,902 for 2022. You have to be careful here because we're having to go from right to left. 22, 23, 24. The instinct is to go 22, 23, 24 to do the other way. But yeah, always be careful there because it can cause problems. Well, you just end up getting it wrong. Okay, yeah. Whoa, no, beauty looks all right. Food and beverage, 22,918. 23,889. 23,828. So yeah, food and beverage is flat. Hard lines. Home furnishings, 19,463. 17,760. 16,699. Wow, that's it's quite a drop. The reason why I'm copying it rather than getting the thing out again, even though it feels a bit far to go up, is because the formatting is correct on the other one and it can just copy straight over. 18,746. 18,614. There we go. Okay, this is a small segment. 247, 213, 217. And even though there's no comma in these, always formatted so that it's the same. Advertising 404, 522, 649. There we go, almost done. 734 for credit card. 667, 576. Other is 394, 420, 521. Okay, oh, I forgot to do all of my okay. And then yeah, we'll do at the bottom here already. I think it's 2L, 01, border. The total revenue is the sum of each revenue segment. For this one, there's so many. Sorry, I'm using the mouse. $109. Yep, got it right. Pull it all along. Ooh, okay, now let's do 2025. I haven't actually checked if they've broken it down. Hopefully they have. Yeah, perfect. Okay, 6 months ended. Okay, as usual, we see what happened in 2024. 8158, so 2.023. 2025 equals 7797 multiplied by 2.023117. Let's call it. That's not a good start. Again, it's declining, or forecast to decline. Divided by 6503, 2.02. So it does look like Target does better towards the end of the year. No, in the second half of the year than the first. Food and beverage. 11391. Okay, this one should be better. 2.099183. 1% increase. hard lines. 6482, 2.435, 6597 multiplied by 2.43505. Household essentials. Sorry. Other merch. This one really doesn't matter. It's such a small part of total revenue, but obviously we want to be as accurate as possible. Advertising. 292. Is that right? 649 divided by 292. Yeah. Oh, 83. Why did I do that? 379. Yeah, that's more like it. 576 divided by 286. Da, da, da. 521 divided by 241, 2.16. Oh. Well, these bottom part, there's not really anything growing that well apart from advertising. Okay, and if we look the revenues, it was $109 billion in 2022, and it will be 104 this year, which, I mean, the performance is terrible when you consider how well Costco and Walmart are doing. It's not great. And they have announced, I think, that the CEO will be moving on, so there'll be a new CEO. So we'll have to see if performance does improve. So apparel and accessories. Well, let's say this eventually gets to. Let's say it eventually gets to 2% growth. Let's be generous. And the bear of that would be 95%. And the bull case would be 105%. So you can bring it down here. What's the thing? G9, always G9 equals G9. We remember how to do this. You take the previous year. Well, yeah, the previous year minus the previous year minus the final year. We divide it by the latest year minus this. Now we need to remember what we want to lock in. So well, that we want this locked in, we want this one, then we want this one. Yeah. I think for this we just put it all to percentage, to decimal place, leave it as that. Then we copy it down. Okay. Do I think this is a bit aggressive? Is it a bit the average of these three? Okay, let's E9. Okay, so for this we probably have to do it as divided by E9. No, sorry, what am I doing? That would be, well, that's not the bear case because that's better. So we have to do it the other way around. If it's a negative, we have to do it the other way around because otherwise it will make it a higher number in terms of the, what do you call it? Yeah, it will be a higher, we want this to be lower basically, as in like more negative for it to be a bear case and it to be less negative to be a bull case. If it was positive, so we would do it the normal way, but we just have to sort of, oh sorry, yeah, we just have to make it well, when it's negative we just have to make it exception. So we copy this over until it gets positive and then we switch it around. I know it can get a bit confusing at times, but I mean, blame target for not performing well and having revenue growth rather than, it just makes it difficult for us when they underperform. Oh, sorry, can you see it? There we go. So this, remember how we do? We go equal offset the cell that we're in, G30, the switch, and remember to lock the switch in, and then comma, then 0, and there we have it. And just format it as so. We just pull it all across. And now the revenue growth, well, the forecasted revenue, we take the previous, multiplied by 1 plus whatever the growth rate is in here. We just close it like that. Let's copy this over. So this one's not doing too badly. It's 6% growth. So let's say long term for beauty that it does have a 5% growth. G10. I mean, I guess really what we should have done is researched what how well the beauty industry is growing, and then put it closer to that. But for now, we'll just do it like this, and we can yeah, perfect. Yeah, we can see. No, I've done this wrong. There we go. The cell that we're in, G37. Then we're going to go log C. I think this is going to be C10. Yep, got it. Perfect. I forgot to put offset in. So I mean, beauty should do quite well. Food and beverage. It doesn't look. So K46. No. What would we say that? Let's just go 1% growth. G11. Offset. G44. C11. Yeah, got it. I mean, it is the largest part of the business, the food and beverage. So it's about, just over or around a quarter of total revenue. A bit below. Hard lines. Well, this came back to growth. So let's be a bit more optimistic for next year. And instead of doing the average, let's say it's going to have a 1% growth. And we'll just keep it as 1. 12. Let's pick up this one just because it keeps the formatting the same rather than this doesn't look home furnishings. Again, it can't keep going down like that. 3 years, I mean it can, but let's be optimistic. Again, let's be optimistic. Let's give it 1%, and we'll see. Okay. And then this one as well, we'll just go as 1%. Should we? Oh yeah, we'll say 1%. When you are doing these though, do look at what the analysts estimate, and then you can generate your own forecast that way rather than sort of what we're doing now. Now it's just more about how do we build it out rather than whether it's other merch. Again, we'll keep it at 1% because this, huge 14% to 8%. I'll just keep it for 1% for everything, 15. I mean, it's got to be able to find some revenue growth somewhere though, because I mean the margin is tiny as it is. So there's not really much room to cut there. So the only thing it can really do is grow the top line. And then, well, for that, it then has to try and eat into the market share of Costco and Walmart. Which it can do, because I think that's why it was at one point, what was it, nearly $250 per share, $250 per share. That's up. Let's just put that down to 10. What is this, advertising? Or yeah, advertising. Let's say this eventually goes to 10% per year. Okay. This is this. I mean, it's not great. Would this be G17, I think. Sorry. And, let's put it as 0.5%. Let's be generous. It'd be so depressing having to go to this company every year and it just keeps, well, its revenue just keeps declining. G18, was it? Yeah. This one will average. And we'll say it settles at 10% or other. this. Oop. There we go. Okay. So the revenue, well, we're anticipating it to have a bit of a revival. I mean, how much of a revival it can have, or turnaround it can have, is well, I mean, it's hard to tell, but let's say that the worst is over, and like this peak of 109 to then decline year on year. Let's say it starts making a comeback and the growth gets larger. So yeah, somebody will think of a way, surely. Now we go into the income statement, and we only need two items here. One of them being revenue, which we have. And now the other one is going to be net income. And for that, on the financial statements, we go up to the income statement and we take net earnings. But first of all, we have to go on to the previous years. Where is it? There we go, net earnings. And we want this to see what this is a percentage of. So net earnings 2780. But this is good. I mean, maybe I spoke too soon, but look at this. In 2022, I mean, the margin was less than 3%. The net margin was less than 3%. Then in 2023, look how much it jumped by. I wonder why that was. Did they sell anything? As in, like, sell any assets? No. Okay. Well, no. I mean, that is pretty good. 4091. So they did go after efficiencies. Net earnings. So if we take last year and we go divided by 2134, we get 1.91. So if we go 1971 multiplied by 1.9143659. Okay, yeah, it's not going to be good this year. Okay, let's just forecast out the can do that here. We don't need to do it in the next bit. Okay, 3.77, and we'll say, well, let's say it goes up to 4. G20. Has it hit 4 in the past? Yeah, I mean, is it a proper 4? No, not really. Okay, let's say 3.8. We'll say 3.8%. G20. have to put your switch in for it to work. Otherwise it will just show up as 0, and then no. This equals okay, perfect. Now onto the cash flow items. And these, I mean, the usuals will be in there. Depreciation and amortization. CapEx. So we need an extra here. We want percentage of revenue. Change in net, this is change in net working capital. And the next two, we want to have, I'll show you on the, it will be on here, it's on the cash flow statement. So financing activities, we want additions to long-term debt and reductions of long-term debt. So that will be, so these will be called debt raised and debt paid. Debt raised, and that's the additions. Okay, let's start populating it. CapEx, what are we saying? Investing activities, expenditures for property and equipment. 5528. 4806. 2891. Now the change in net working capital, oh, this isn't too bad actually, this is easy, equals 403 plus all we do there is we just do the sum of these. So 403 plus 22 minus 2237 minus 624. When it's in brackets, it means it's negative. We divide it by C105. 24 equals 1613 minus 85 minus 1216 plus 727. Ideally, this number is negative because then it's favorable for free cash flow. Because when it's negative, and obviously the part of the formula for calculating free cash flow is minus change in net working capital. So if you minus minus, it becomes positive. So it equals minus 854 minus 30. Okay, now the debt raised. Where is it? Additions to long-term debt 2625. It was 0 in 2023, 741 million in 2024. divided by C105. Now the debt paid was 163, 147, 1139, okay, let's do the 2025 one. Where is it? Here we go. You know, we can just multiply it by 2. Let's not take too much time. If you want to do it in the more, find the actual ratio, go for it. But for now, we'll just do it this way. Maybe multiply this one by 2.1. Doesn't have to be overly right now. Equals minus 114 plus 151 minus 1125 minus 302 multiplied by 2. We need another bracket there. Looks good. See, this is going to look good on free cash flow if it stays like that. Then additions to long-term debt. I mean, look, right now we're not going to say we'll keep it the same because it doesn't necessarily mean in the second half of the year they're going to take on more debt. 1571 equals C105 multiplied by C105. No, it's not C105. It should be G105, sorry. Yeah, all good. We'll see. Now this is going to, I don't know if we'll get a good forecast here because this is going to look as if it's really good free cash flow because it's negative. But we'll see, we'll see. Okay, now it's looking good. Now to work out the levered free cash flow, we need to, let's put a border in. So this is going to equal, we take the net income here, we add back in depreciation and amortization, subtract CapEx, subtract the change in net working capital, add the debt raised, and subtract the debt paid. And we go to there. You just pull it across. Now we have to work out the present value of LFCF, levered free cash flow. Okay, so for the cost of equity, we'll just, what we'll do is I won't go out and build how I normally do, because I think we'll just do the risk-free rate being, is this right now? 4.144%. Okay, and we have our, has it been updated? %. Okay, and I think the beta is, we'll go retail general 0.99. Okay, yeah, let's do that. So if we remember correctly, cost of equity, let's come in a bit more. This equals the risk-free rate plus the beta multiplied by the equity. Okay, I'll write it down. Risk-free rate plus the beta multiplied by the equity risk premium. So if we go RFI, it's 4.114%. Is that right? Did I get it? Yeah, 4.144. The beta 0.99 for unlevered. When you take in the, we'll leave it at 0.99, and then another day it's because it's going to come out similar anyway, I think. It might not, but for now we'll leave it as that, because I've got to get ready for work tomorrow. 3.68%. There we go. So we'll say that, yeah, 7.7572%. Let's round this up to no, not like that. B9 equals and the bear case would be add 0.5%. And the bull case would be minus 0.5%. And we'll do the terminal growth rate at 2%. I don't think it's going to be that good. You go cost of equity and you go equal, choose, then you select these three, but in order. You can copy it down. Okay, we're good to go. We're good to go. So the present value of, okay, we need another line here. divided by 1 plus the WACC, sorry, the cost of equity, oh sorry, yeah, I'll do that again. Divided by 1 plus the cost of equity to the power and lock in the cost of equity Okay, now it's similar to what we were doing last time. The terminal value is going to equal, the way we do that is we go equals, and then yeah, it's the same method as we use always, equals the levered free cash flow multiplied by 1 plus the cost of equity divided by the cost of equity minus the terminal growth value. And so that gives quite high. Now we want the present value, PV of TV, and that equals 1 plus the WACC, not the WACC, the cost of equity, to the power of the final year, which is 5. And that gives us this figure here. Now the equity value, because we're not taking into account into debt, the debt, we say the equity value is the sum of the PV, present value of the terminal value, and we add up the present value of the levered free cash flows, and that gives us 84 million. Now we want to find the diluted shares outstanding, and that is, where is it? It's on the income statement somewhere. Okay, yeah, these 456.1 million. If shares are being reduced, 463 the previous year, 456 now. You'd rather it was that way than the other way. Then we say implied share price. So there is upside to this theoretically. 184 is not realistic historically for target. I mean, where it is now, it's a long way to go, but yeah, that's quite good. K141, remember that? Equals why is that not working? Equal. Yeah, okay, there's upside there. Now, but let's look at the dividends. So yeah, the dividend didn't really grow this year. Actually, no, it has grown because the dividend payments increasing and the diluted shares outstanding are decreasing. So its dividend per share is rising. So okay, let's 10. Let's just multiply it by 2. So dividends paid for, let's call this for 2020, for 2025. We'll call it, so equals 1019 multiplied by and if we forecast it for we'll say 2025, and if we let's work out what free cash flow generated for 2025 is. Maybe I can just do that. Can I? Okay, so if we say dividends paid was just over $2 billion for 2025, the levered free cash flow generated was 4,778. So the dividend coverage will equal, you take this year's free cash flow and you divide it by the dividends paid. What? $2.34, and then okay, go custom. Put an X on the end. See, I mean, it can more than cover its dividend, and it's got room to grow its dividend. I mean, the growth in the dividend isn't great though. But if we see the share count go down, as it has been, they're doing that through buybacks and yeah, through buybacks and hopefully being not adding stock to the share count. So yeah, I mean that's quite compelling. So it's 2.34x. It's got room to increase the dividend. I mean, we are being, I guess, fairly optimistic. So maybe pull this down a bit, and then, yeah, it's not too bad. What is on the worst case scenario if we put everything to 1? Where do we see the company? $127. So in a worst case scenario, well, a bear case scenario, it's 128. And what would that do to? Obviously, you won't do anything yet because it's. But yeah, this is where we get worried in that next year, dividends will probably be 2.1 billion, and free cash flow is forecast to be 3 billion. So it doesn't. Ideally, you want this number to be more than 2. Certainly that's how they do it this way. On net income, you want it to be 2 times what the dividend payment is, and we're doing it on free cash flow. So sometimes they might be using debt to pay the dividend, and yeah, it's not good. But it's yeah, I mean that's what we found. So let's follow it. Let's see what happens. But thanks for listening, and yeah, we'll go on to the next one soon. Thank you. Bye.